All right. Well, welcome back to the iWealth podcast. And today we're talking about the Fed, interest rates, and investments, and how these three things all play together. I'm joined by Mr. Brad Connors, the man, the myth, the legend. And we're going to talk kind of through that from a 20,000-foot overview.
Yeah. I mean, there's been a lot of movement with the Fed. And if you didn't know who the Fed were over the last 12 months, you figured out who they were. As you know, we were used to 3% mortgages, and now they're 7 or 8%. Yeah, it's crazy. So we had a lot of movement last 18 months. Record amount of Fed rate hikes. That's moving those interest rates up, and we get a lot of questions, Matt, about like what should we do? How do we handle this? And for the most part, if it's long-term money, make sure you're diversified. Make sure you're in proper investments. Maybe shorten your duration of your bonds, but you kind of ride times like these out.
Yeah. Do you think that there's some truth around this fact that people are kind of staying put right now? Because the interest rate has kind of come up, and I'm hearing from real estate people that are in my world, like nobody's really moving right now, just because there's some uncertainty there. Yeah,
yes. But it's interesting because go back to the 80s when rates were at 9, 10, 12%. People still bought homes and moved, and jobs changed and things. So it's not like things are going to come to a halt. But yeah, I would think things slow down. If you're at a 3% mortgage and you want to move 2 miles away in the same town you're in, and you're going to have to get a 7% mortgage, you might think differently about it.
Yeah.
You might remodel your house or do something like that and take a short-term note out if you need to borrow, instead of selling your house and getting into a 7% mortgage. So yeah, it's just an interesting time. We had bonds down 13% in 2022.
Okay.
Worst time since the 70s for individual just government bonds, and it's just because of the Fed raising interest rates. And now that we sit here early 2024, the Fed's changing course. And so the markets had a really good year last year, especially fourth quarter, because Fed's done. They believe Fed's done, and they think rates are going to actually get cut next year. So that 7% mortgage might be down to 5%. What's interesting is when you think about like demographics and you think about ages of people.
Yep.
So people in their 70s, this is a return to normal.
Yeah.
Return to normal is a 5% mortgage.
Yep.
Not 3%, like it's been low forever. If you're in your 30s, you're saying, oh my goodness, what's happening? Mm-hmm. Because it's going to be higher forever.
Yep.
I really don't believe we're going back to 3% mortgages. And so if you're in the middle, you've seen some high mortgages, you've seen like this is normal. So it's really interesting on perspective.
What is your perspective? Does this feel normal, or does it feel high?
It feels normal.
Because you're kind of in the middle of all of that. This feels normal.
Yeah, it feels normal. Unemployment doesn't feel normal. Normal unemployment is 5%. And we're at like 3.5 to 4. And it's going to be hard to get it higher than that because there's so many jobs that are out there with onshoring coming back and manufacturing coming back, which I think is awesome for the United States. I think it's going to be hard to get to the historical norm of 5%. Maybe we will at some point. That's one of the mandates the Fed wants, is they want more unemployment, which means the economy is slowing and things like that. But yeah, I think from an interest rate standpoint, we're a little bit high. It'll come down. But I think that 5% mortgage is probably where we land. So we'll see. We'll see if I'm right or not. I don't have a crystal ball, Matt. So
there you go.
Yeah.
And for those of you guys that want to move sometime soon, Brad would say,
maybe it's okay.
Maybe it's okay.
Yeah, I mean the mortgage.
It depends on your perspective. That's what Brad would say.
Exactly. Go get a good deal in the house, and it's worth it. But yeah, I mean your 7% mortgage might be 5% at the end of the year. If you look at what the stock market and the bond market's telling us, they would say it's going to be closer to 5%. But nobody knows for sure.
Nobody knows.
Yeah.
All right. Well, there we go. And if somebody wants some help thinking through this, how do we go about that process?
Yeah, I mean, they can get a hold of us at iwealthforme.com or give the office a call and we can have a conversation about it. Obviously, just make sure you're talking to a trusted advisor or friend that knows what they're talking about when it comes to interest rates.
There you go. We'll see you back here soon on the iWealth podcast.
Thank you, Matt.